answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hanson and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hanson and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hanson.
I'm Pat McClain.
Glad you are with us today as we talk about financial matters. Both myself and my co-host here, we're both financial advisors, certified financial planner, chartered financial consultant. We spend our weekdays helping people like yourself plan their financial futures, and we broadcast on the weekends to be your financial advisors on the air.
When we come into the studio, we think, what is our goal? What are we trying to do? We want people to live a more comfortable, peaceful life regarding their money, especially in retirement, so that they're comfortable in their retirement. They're comfortable with how their dollars are invested, the decisions they're making, and their lifestyle in retirement.
Well, that's a good point. I mean, it's funny because as we all seek comfort and security in life,
yes,
I actually have on my desk at home, I have a little phrase I cut out from somewhere. I think I typed it up. View comfort and what else?
It's obviously made a big impression.
View comfort and safety as your enemy, risk and uncertainty as your friend. That is what I have on there.
Really?
It's because I don't want my own personal life, not when it comes to my financial matters, but in other areas of life, I don't want to spend my life just trying to focus on personal comforts. That's not where I'm going to grow or be fulfilled, that sort of thing. But when it comes to financial matters, I'm totally clear with you there, Pat. Our role as advisors to help people with their finances so that this is one area of their life that they don't have to have a lot of concern over.
Yes. And the reality is, for the average American, your retirement savings is the way that you have stored your labor in order to exchange those dollars in your retirement when you can no longer labor. And labor being working at a computer or building a house or whatever that labor happens to be, you're taking a portion of your labor today and you're storing it. And the big question is, well, how do you store it? Right? Do I put it in something that is completely safe with no risk and then expose myself to inflation? Or do I put it into something that it's going to grow, but has great volatility and may lose some value? Or is it a combination of the two?
Pat, it is such a challenging time right now. With the Feds came out and said that interest rate's going to be zero for 3 years, maybe.
Oh, yeah. They telegraphed that basically don't worry about any changing interest rates rising.
That's right. They're keeping long-term rates low they're buying all these bonds
in the secondary market, which may be giving a false sense of security to the markets as a whole.
Well, there's the old adage, don't fight the Fed, right? So that's what the Fed's been up to. And so what it means, though, is that safe investments don't yield anything.
Yeah. And there is risk, especially in this marketplace. You see these IPOs come out, Snowflake, which is essentially a data warehouse mining where you put your data in a warehouse and they've built tools that you could actually mine that data for businesses in order to get better intelligence, to make better decision making.
So, yeah, Snowflake did an IPO this week, this company. I don't know how old it is, not very old. But the price more than doubled on the first day of trading. It gave it a market value of $70 billion.
Wow. One of the largest IPOs ever.
So investors said, wow, we think this company is worth $70 billion, which is up by basically, it's about 4 times as large as what the company was thinking the business was worth just a couple weeks ago.
Do you think that we're kind of in a dot-com boom again a little bit, Scott? Like the 1997,
by the way,
98?
I'm no expert on Snowflake and haven't done a tremendous amount of research on them, but I'm just from the basic kind of, from a purely financial standpoint, looking from an outsider. The last 6 months, ending July 31st, Their revenue was $242 million.
That's amazing. That's a revenue.
So let's call it $500 million a year.
Yes. Let's double that. Let's just say that they're growing at a rate that it's $1 billion in revenue. And it's sold for 70 times its revenue, not its earnings.
Yeah, so it's sold for 140 times, maybe actually based on this, 150 times their revenue.
That's crazy. Do you feel a little bit like...
Well, that's what this made me feel like. It's not pets.com or something like that.
But Shopify is market capitalization, which means the total value of the outstanding stock at Shopify.
What the heck is Shopify?
It's a platform that allows small retailers to sell on the internet. Has a market capitalization, last I looked, equal to or greater than that of Target. Equal to or greater than that of Target.
Which means which means investors are betting that that Target's long term is not going to do well,
and that this will.
Yes, that's what they're betting.
Yeah, but then when you look at Facebook, Google, Netflix, all the those companies, you're just the prices are astounding that based on their earnings, the multiple of earnings, but the stocks keep going up. Tesla stock keeps going up.
Well, here's the strange thing.
It kind of feels like the late 90s to me.
Well, if you drill down, you look at something like Snowflake, and I scratch my head. I'm like, how can something trade for 150 times its revenue?
Well, now there's three types of snowflakes: the real snowflake, the people, the snowflakes, and now the company. Which snowflake are we talking about here?
That if we look at kind of how the markets have performed here. And this is through data through about a week ago. All right, so it's close enough, but it gives you an idea. So year to date, the broad market, S&P 500 up 4%.
Which think back in March, April, that we'd be actually saying that the market was up for the year.
In order to get that means you've also roughly a quarter of that capitalization as those stocks that you just mentioned, right? So a handful of stocks are driving that higher. But if we break it down further, if we look at large company growth stocks, they are up 18% for the year.
Which means that value
down 11% for the year. The worst performer, small cap value, year to date, down 21%. Now, these are companies, value companies tend to have better current earnings, better current prospects.
Lower price for the stock relative to their earnings.
Value stocks as a general rule. Down 21%. Even small cap growth companies year to date are down 8%. And even if we go a year out, we're still looking at small caps are negative for a year.
And what do you think drives that? Do you have any sort of a thesis around this, Scott? Momentum?
Well, a lot of it feels like momentum. And if you look at the number of people trading today on things like Robinhood, there's trading, right? The industry made trades free, trading options almost free, or at least it looks like it's
trading
free.
Partial shares. You don't even have to buy a whole share. Parts of a share of a stock.
People, when there's no sports betting going on, people turn to betting on the stock market.
Good point.
I think there's a lot of speculation right now. It's a really interesting time. And I think for investors, we talked about, Pat, you were mentioning it equating to stored labor. I think people need to be really careful about how those dollars are allocated. And like what happens when a new shock comes, something that we're not expecting right now. What then?
Yeah. What's the black swan?
Yeah, and to make sure that your portfolio is structured in such a manner that you're designed to weather whatever that new storm is going to be.
So I had a conversation with a client. So we have, I don't know how many advisors work here.
80 plus.
80 plus advisors that all work. But I have a few clients. Scott has a few clients. But we've been practicing advisors for almost 30 years. So I had a client who asked me, well, what about these protection? Can we buy something, put options on the market, protection to give me some downside protection? And I said, yes, you can. But the reality is it's really
expensive.
And they oftentimes don't protect for what they call a black swan or once in 2 decades or 3 decades occurrence, like a pandemic.
Right.
Right. So they'll blow through those backstops. And they said, so the way you want to think about your portfolio is, how do you live through financially, comfortably market cycles? And I said, so we're talking about his own portfolio, which is, we make sure that you have enough money not at risk in your portfolio
To weather out the storms.
so that the things that are at risk or have market volatility have time to recover. And then you convert those at risk to not at risk in order to keep your portfolio well balanced, so that we're not buying expensive insurance products for the downside in the market. And his response was, wow, that makes perfect sense. Which is, look, you can insure for it if you want,
It's very expensive.
but it's really expensive. And it isn't insured.
And long term, that insurance cost will take a tremendous drag on your portfolio.
That's right. So it's just better to actually accept the volatility in the marketplace and make sure that your portfolio is properly allocated in order to weather these types of storms.
And if you want to invest in something like a Snowflake IPO, use it for a small percentage of your portfolio, right? So, look, particularly at retirement time, this isn't the time in your life when you can afford to make mistakes with your dollars.
Yeah, this is most people in retirement don't have time to recover.
Well, anyway, why don't we take some calls? 833-99-WORTH is the number to be part of Allworth's Money Matters. 833-99-WORTH. We're starting off with Dennis. Dennis, thanks for being part of Allworth's Money Matters.
Thank you for taking my call. My wife and I lived for many years in Sacramento and always appreciated the great impartial advice you guys give out.
Oh, thank you,
Dennis. Where do you live now?
Yeah, where do you live now, Dennis? Idaho, Texas?
Santa Cruz on the Mother's Day.
Got it. Very nice.
So my question is about kind of a two-pronged question about RMDs and refinancing a mortgage.
All right.
I can give you a little background on
Please.
it. Both my wife and I are retired. I turn 69 next month, and my wife is 67. We've been retired for about 8 years. We did follow your advice. At the time we retired in Sacramento, we owned our home outright. And we then bought a house with those proceeds outright here in Santa Cruz. But 4 years ago, we decided we're really not touching the retirement savings, the nest egg. Let's get a place we really love. So we now have just a hair under $1 million mortgage. Okay.
Okay.
We both have 3 pensions between us. We both are receiving Social Security. So we have a fairly reliable income of about, $250,000 a year. And we have about $2.7 million saved for retirement. And of that, about $2.2 million is in my wife's IRAs and tax deferred accounts. About $288,000 is in my deferred accounts, and the rest is in post-tax investments. And since I'm turning 69, I know that RMDs are coming up into my future. We're currently in that 24% tax bracket. But the next big jump up is 8% more to 32%.
Yeah.
So what I'm thinking is, we probably should have started this earlier, is we should start converting into Roth IRAs, just enough to keep our nose under that 32% in taxes each year. Now, my wife's only 67, and since she has the bulk of it, that would give us a few years.
Yes.
Yeah.
You have 5 years.
If you do the calculations on R&Ds, her first year, she would be required to take out something like $80,000, assuming her, that's a big
I know.
change. But anyway, our current mortgage is a 30-year mortgage at 3.875, and we've gone to a broker to look at financing options. And we pay about $4,700 a month in mortgage, and of course we really pay a lot in property tax, $2,000 a month in property tax.
But you know what? But you're in the place you want to be in your retirement, and
you've got plenty of money.
You can afford it. So
yeah. So good for you.
We love it. It was a wonderful move that we made 4 years ago when we took this giant leap. But right now, in terms of refinancing, we could actually go to a 15-year mortgage at only 2.25%, but we have to get out of the jumbo loan.
Yes, I was hoping you were going to go that direction.
Well, and that means $765,000 mortgage, which means we'd need to come up with, pay that difference. It ends up being about $165,000.
Yes.
To close the loan.
But Dennis, you mentioned three things in the retirement plan. You mentioned your IRA, your wife's IRA, and then you said that there was money outside of IRAs.
Yeah, how much is that?
How much is that?
We have about $297,000 in non-tax deferred accounts.
Okay.
We also have about $250,000 in cash.
Okay.
Oh, plus $250 in cash.
Oh, this is easy.
Yeah.
So you're going to, I don't know why it matters really if you get a 15 or 30 year.
It's a no-brainer to take, from my opinion, take the money out of the bank, the cash that you're earning next to nothing on.
Pay down the mortgage.
Pay down the mortgage so you can get a conforming loan. Cause jumbo rates are really expensive right now relative to conforming loans.
Well, actually, if we went with a 3-year fix instead, we would be offered a 3% interest rate. But it does mean that our monthly mortgage would drop from $4,700 to $3,900 a month. And we're thinking, well, no matter which, 15-year, 30-year, 15-year, I'll be like 84 years old at time for moving into assisted living.
Right.
So it really, and we have no children. We don't, we'll be giving away to charity probably whatever money we have.
Okay.
And so
wait. Let's stop. Let's stop for a second here. So
sure.
If that is the case, and you have no children, and the money is going to charities at your death, then you should consider taking those RMDs and going directly to the charities while you're alive.
Okay.
Right?
So you can take.
Yeah, I've heard of doing that. Uh-huh.
I mean, to Pat's point, if this is truly, it sounds to me like, you haven't taken any money from your retirement accounts, right?
Oh, a little bit, but
how much?
Not much.
Okay.
We re-roofed and we did some big projects on this place. We took a little bit of money, $60,000 or something out.
Okay.
So, I actually like the concept of converting some to a Roth today. But when you hit the required minimum distributions under current law, which is now permanent part of the law, you've got the option to, instead of taking those distributions yourself, you can send them directly to a charity or charities.
Yes. So for many of our clients at the beginning of the year, they give us a list of their charities. And some of them we do it on a quarterly basis, and some we do it on an annual basis. And they say, okay, I want a quarter of my required minimum distribution to go to these 4 charities. And they tell us how they want to get paid out. We don't like to do it any more than quarterly just because it's a pain in the butt for us, quite frankly. And it achieves the same objective. So that's one of the ways. So I agree with Scott. You should do.
That's something to consider, because what sounds like right now, you're trying to figure out, how do I maximize cash flow? How do I reduce my mortgage costs as much as possible? And how do I deal with my retirement accounts when I've got this looming tax bill over my head?
Yeah.
So
exactly.
if you were sitting in
and if you just said to us, we have no kids, long-term, charity's going to get it.
Well, then,
and it doesn't have to be all the required minimum distribution. You could start with some portion of it, but That would be clearly in my toolbox of considerations when I'm doing my planning at this point.
But if Dennis and their wife were sitting in the office, you'd say, look, go ahead and pay down that to get to a conforming loan.
No question.
And do a 30-year rate mortgage, because that way
you have more free cash to spend.
You have more free cash, and if you at some point in time you want
what's
to
the rush of paying it off?
So the charity is, you're not going to spend all this money in your lifetime. I would encourage you to actually spend more money. That's if you were comfortable doing that.
Yeah, well, we've always traveled a lot for the last 45 years. We've done an incredible amount of traveling, but of course, that's
not right now.
Yeah, but when you travel,
now you can't even go to the beach.
So, Dennis, when you travel, do you travel first class? Do you sit in first class?
No.
Okay, from now on, from now on, we want you to sit in first class. We want you to.
Hard. My wife is jumping up and down.
Listen, Dennis, I tried to sit in first class, and you know what my wife said to me? I bought you a neck pillow. Okay.
But no, true. I mean, you're talking about just a lay flat seat, right? A business class seat of some sort. But I mean, I think it's some of those things to consider. And here's the funny thing, the challenging thing. You are in this position because you've been good savers.
We did. We saved a lot.
Right? And you had jobs where you had a pretty high assurance you're going to get a pension. So you could have said, you know what, let's just blow it all. And you've always lived a little below your means and you saved. And now you're at retirement with roughly $3 million. Well, you've got $3 million in savings when you count the money you've got in the bank as well. And you've got pensions and Social Security bringing in $250,000 a year. I mean, it's like.
And presumably you have probably $1 million of equity in the house.
Yes, we do.
So
the house it's $2 million, and so what we rolled into it was $1 million.
Yes,
yeah.
that was my
$1 million loan.
That was my guess. So there's what I would do if you're sitting in my office. We would have this conversation. Any of our advisors would have this conversation, which is, listen, you're not going to take it with you. You worked for it. It's hard to actually spend money with someone that's saved as well as you have.
That's right, you have it. If you would have traveled, go talk to someone at the Mercedes dealership and ask them who the typical buyer is. Seriously. And how hard they work to get the financing for those cars, right? I mean, you didn't drive a Mercedes over the years. You didn't travel business class. And that's why you've got all these dollars saved.
So you want to do all those things. You want to convert your IRA to the Roth till required minimum distribution. And then at that point in time, you want to sit down with your advisor, or if you don't have one and you've got one on the air, then you want to actually look to see where those dollars should go to a charity or charities for a portion of that. Some of it can come as income. And then you want to actually take that money out of the bank, pay down that mortgage, get a conforming 30-year fixed rate mortgage, and then slowly, you don't have to do it all at once, you can start spending more money. And I'll tell you a quick story. I have a client who I've had for years and years and years and years. Great guy, great guy. Grew up dirt poor. Was an incredible saver until his mid-70s when we started talking about, and he had no children, by the way. And I said, okay, I want you to start traveling first class. And he did it. And he said, we now love to go on cruises, stay at the nicest cruise lines, nicest rooms. And then now they fly first class. Well, 2 years ago, he called me and asked me if he could charter a jet.
He said, now you hit the limit.
And I said to him, slow down. But we did
That's a jump we could never make.
Well, but we did the number. We did the numbers. He has more than enough income. And subsequently, about once a year, he charters a jet for his wife and his friends, and they go somewhere special. It is his big splurge.
And now, for him, that might be fun. It might, for others, would say that it has zero appeal whatsoever. But the cool thing that you've got going for you, you've got more assets than you need, and it gives you a chance at this stage in life to say, what do we want these dollars to do? What impact can we have? Whether it's on ourselves and friends and chartering a jet, which is or maybe it's with some cause that we feel strongly about.
It's
all those things.
You're not going to run out of money. In fact, once you hit 80s, you're not even going to be able to spend, if you're like most people in their 80s, you're not even going to be able to spend the money from the pensions because your health won't allow for it. You won't be as mobile. So the next 10 years, you just, but it's psychologically, it's hard getting there. Because the reason,
and we're not trying to tell you how you should be thinking about but the fact that I think those are bigger issues to like what these dollars are going to do. What impact can you use these dollars for? I think that's actually a bigger issue than
the mechanics. We just gave you the mechanics of what you should do with the money. But what we want you to do is think about this, have this discussion with your wife, and the reality is you're not going to run out of money. If you run out of money, you can move in with me. How's that?
And for years, I've told people, particularly don't want to take my advice. I'm like, hey, you can't move in with me. So,
but I'm confident enough to say that if Dennis and his wife run out of money, they can move in with me.
Okay, good. All right. I'm sure Kathy will feel great about that. We're going to take a quick break. Stick around for more of Allworth's Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Thanks for sticking around. Money is a funny thing. It is. Money's a funny thing.
So, speaking of money, we'd like you to go to our website, allworthfinancial.com. And the reason is we have a number of new articles, and we track what, you might find this hard to believe, but we actually track what people are actually looking at on our website. We can see who is looking at what. And two resources on our website that have been doing really, really well, which is, one is the 3 big ways retirement planning has changed. So I'd like you to take a look at that. And the other one is our retirement resources guide. So that is at allworthfinancial.com. I do need to make one other statement. We have asked people in the past that listen to our podcast to please rate it. Unfortunately,
review it.
Review it. Unfortunately, not every podcast platform allows for reviews. But the Apple Podcast platform does allow for that. So if your platform that you're consuming your podcast from allows for reviews, please review us. If it doesn't, then you can't. And the reason I'm saying that is because our people in radio said that people have been calling saying, hey, Scott and Pat asked to review their podcast, and we don't know how because there's no. But I guess not every podcast platform.
But it's kind of, even on the Apple, whatever the thing I listen to, my podcast, Apple Podcasts on my phone, even that's sometimes a little hard to figure out how to review something. Because I'll review some other podcasts sometimes.
I should do that. I ask people to do it all the time.
The ones you like, you should go and review.
I should. I tell people about them, and I send them to other people. I share podcasts quite a bit, but I don't. All right. I share with my children a lot. What am I trying to say?
I've learned.
What am I trying to say here?
If something comes from me to my older kids, it might as well not even.
Right, it's got a negative effect.
My wife Valerie say, "Well, why don't we let's communicate this with." I'm like, I look at her like, first of all, don't you think they heard that about 8,000 times when they were living with us? And now, if I say it to them,
it's got a negative effect.
Yeah, it's correct. They're going to want to do the opposites. Anyway.
But my daughter will share podcasts with me quite often. I like them. A little liberal.
Okay. I was having lunch with my son a while back. I said, can we talk about something else besides politics, please? Because I think he likes to poke at me a little. And he's like, well, there's a lot going on in the world right now, Dad. I'm like, okay, we can't sit and have this conversation.
Can't we just be like I was with my parents and talk about the weather?
Anyway, let's go back to calls. 833-99-WORTH is our number. We're talking with Joan. Joan, you're with Allworth's Money Matters.
Hi.
Hi, Joan.
Hi. So you want me to go ahead and just...
Please.
throughout everything?
All we know
Okay.
about you is that your name is Joan, and you've been very patient waiting for us to take your call.
That is the most we know about you.
And maybe
So-
you haven't been patient. Maybe you've been cursing and stuff, but we haven't heard any of that. From our perspective, you've been patient.
So tell us about your situation, and we'll see if we can help.
Okay. So I'm 62. My father recently passed, and he had a home that is currently the value is about $350,000. It is paid off. I have a home, and it's probably around the $250,000, $260,000 range. I owe $90,000 on my house. I have two 401ks that are from eons ago. One was like 15 years ago. One was like 8 years ago, and one is $24,000 in the 401k. The other's about $23,000. In cash assets, I have about $150,000, and there's also the assets of my father's that hasn't been accumulated, which I don't know is going to amount to much more than $10,000.
Okay.
So my questions are, I'm like many callers right now. I'm thinking of leaving California. So I want to sell my dad's house right away. I feel like the market is good.
And did your dad have a trust set up or a
Yes.
will? He had a trust set up?
Yes.
That
And
makes
are there
sense to me.
any other beneficiaries other than yourself on your father's trust?
There is one.
Okay.
Sibling?
Yes.
Okay, so it's half-half? 50-50?
It's half-half.
Okay.
But ended up that kind of got a little diluted to things being settled where this is what I'm going to take.
Okay. So this is at the end of it. It's $360,000.
Right.
Okay.
And then there's also some cash assets.
Okay. Well, you said 10,000, and you said the value of the home was 350, so I added them together, so 360.
Well, no, the 10,000 might be like estate sale, vehicle, etc.
Oh, how much cash assets are there then?
About 150.
Okay.
Yeah, that was the 150,000 cash. Okay,
Okay, got it.
Yeah.
So this is an opportunity for you to make sure your retirement is secure.
Are you retired now?
Yes. Well, I'm on Social Security disability at 62.
And how much you receive a month?
$1,400.
Okay.
And what have you been living on up until now? Just that?
Yes, that and some help from some family. So I did want to preface by saying that I have led an extremely conservative life all of my life, very much just survival type mode. So I'm not an investor. I'm not, savvy in finances and so forth. So this is all new ground for me.
Joan, when you were working, how much money did you make a year, approximately?
My last year, I was about 90,000. Prior
Okay.
to that, I was ranging anywhere from 60 to 70,000.
And how long have you been disabled?
It will be. This is the 5th year.
Okay, thank you.
What are your let's assume that the estate is settled. What are your thoughts?
So my thoughts. I had a couple of different questions. So my thoughts were moving out of state and buying property in another state. And on top of that, I've got this $90,000 left to be paid on my mortgage,
Right.
which is a 5.7% interest rate.
Yikes. Okay.
So, yeah. And so my initial thought was take the money from the house, put it into the house that I have currently I'm residing in, and get kind of a return on my investment of 5.7 until I make that final decision to move.
Perfect.
Or do I, not put the money in it because I'm thinking of selling, but I'm not 100%.
Let me ask you this. What's driving you to leave California where you've lived?
Why are you leaving? Are you going someplace where you know someone, where you have children? What's driving that decision making?
Other than the fires.
and the
high
tax rates
and the blackouts.
Other than those three things, what's driving you to leave?
Okay, because those are what's driving me. No. But also, I have two children. Well, one is married with 3 children, so I have grandchildren, and we are thinking of all going together, but nobody has left yet.
Got it.
Okay.
So there's I wouldn't be going alone. It wouldn't be like I'm going into complete. I'll have my family with me when I do go, and that's where I was trying to decide between investing in something that we can all enjoy, maybe have a mother-in-law house on the same property where I have some privacy, or do I spend my money on a long-term care insurance policy so that my children aren't burdened with me in 20 years or so? Those were different thoughts that I had as well.
So you've got, with this, you've got 600,000.
She's got 510, so 350, 150.
It was inheriting 500, and that's another 150,000 or so.
No, the 150 was actually included in, that was part of the dad's estate.
I understand.
Okay.
And the house at 350, there's 500.
Yeah.
And her home's got about 150,000 of equity in it.
Okay.
So $650,000 of cash.
Okay.
If long-term care was a huge concern, you could take some portion of that and buy a policy that will guarantee some costs in the future. But part of my thought is that's a lot of money to pay for care. That's many years of care if someone actually needed care. And before I bought the insurance, I think I'd really take a good look at it because you might have enough assets to self-insure for that.
Here's what I think you should do. Immediately pay down that 5.7% interest with that.
And you're not going to move. You're not going to leave the state until you sell.
That's right.
Father's house.
And you're not going to leave until it sounds like the whole family's going to, mass exodus.
You can load up the wagon.
Right? It's like
going the other direction.
It's like the Okies going backwards. It's the grapes of wrath going the other direction. I'd actually pay that down immediately, and I'd probably keep it all in cash until I knew what I was going to do.
Just in the bank.
And I wouldn't let anyone try to talk me into a big old fat annuity with all kinds of guarantees.
Don't buy anything.
And the reason being is the reason we're saying people are listening and they're like, why wouldn't she invest it in moderate or a portfolio? You don't know what you're going to do.
2 reasons. One, you don't know what to do. 2, you have very little experience with investments. Right. And the number one reason that people have poor investment performance is not based upon the financial markets. It's based upon their reactions to the markets. And the less experience one has, my experience has been that the worst decisions they make. And I think you need to have eyes wide open that it's not the easiest thing to do when you're 62 and for the first time having a substantial sum to invest. It can be done, but my number one concern is that someone's going to sell you some product, going to talk you into something, because I've seen that. I'm doing this 30 years. I can't tell you how many times I've seen people inherit money. They weren't in great financial shape ahead of time. They inherit money that could put them in a place where finances is no longer a concern, and yet they get sold financial products. They get promised these high returns. They ask, Scott, what do you think about investing in silver? And crazy stuff, right?
I remember 20 years ago, you met with a widow that had a large inheritance. Her husband had died, and someone had talked her into buying a big, huge annuity so that it would keep it off the tax return so the kid could get some sort of scholarship for school. Do you remember this? And then she came back 3 years later wanting us to unwind the thing somehow. And
I know who you're talking about because he was a friend of mine who was killed in a car accident.
And it was his wife.
And she was a client of the firm for a while and freaked out in the financial crisis. And I said, why don't you go buy a couple rental properties instead? Because at least you understand those, because you're going to do damage to yourself. And I just heard a few weeks ago that she's having financial problems. And it's a substantial sum she had from this car accident. And my stomach churned when I heard that.
So in your situation, don't let anyone sell you anything. pay down as soon as you can, take and pay down that mortgage. And that for that period of time, you're going to receive 5.7% on $90,000, right? Which is what the cost of money is. And then wait. And I like the idea.
Sell that house, sell your father's house, stick the money in 2 banks so you've got FDIC insurance.
Or go to Synchrony or an online bank and get a little bit higher return.
Yeah, but with the FDIC limits, you'll want two accounts.
And here's what I would caution you on. I like the idea of buying a house from the mother-in-law unit, that sort of thing, if that makes sense. I don't know what the relationship you have with your children is or will be. But just make sure that your children don't become dependent upon you.
Yes, financially.
Right.
Because there's not that much money.
You are not rich by any means, right? And this can set you up forever. And maybe you go in together and buy. Are your kids financially stable?
They are stable. They don't have a lot of asset though at all, but they both have good professional careers that are still vital in this economy.
Perfect.
Good.
That's exactly what I wanted to hear.
Good.
So do like we said, just pay off the mortgage, keep the rest in cash, use an online
I'm glad
bank.
you didn't say, well, my son-in-law has had trouble keeping a job for the last 15 years.
Well, that would have been alarm bells.
Correct. He's a great guy, but he just can't seem to keep a job.
Yeah, are you guys breaking up a little, or is it just on my end? You can hear me okay?
I hear you fine.
You sound great.
Okay. Two other quick questions we didn't mention is I've got those 2 401ks that, excuse me, one's with like Fidelity, one's with Vanguard. They've been sitting there with these 2 employers for years. I've never rolled them or anything. Is there anything wrong with keeping them with these ex-employers?
Not necessarily. It all depends how they are invested with those 2 previous employers. And my guess,
very conservative.
Well, then
it doesn't really matter.
If it's gonna be conservative, it's not gonna much matter. You might actually have a higher yield if you're just gonna leave them in.
Yeah. So if they're conservative, it doesn't much matter.
I don't think for the long term that's probably gonna be your best.
No, I wouldn't leave them. I wouldn't leave them there forever.
But of all the things you're dealing with right now, I would the back burner those.
Yes.
Okay. And if I was to end up selling both properties this year and making that move, you wouldn't necessarily advise me taking a lump sum, a few $100,000, and putting down toward a property that I might reside with family?
No, I don't. There's no problem with that. That's going to be a great idea.
Not at all. Not at all. It wouldn't be a bad idea at all.
Don't have a big mortgage, though.
Yeah.
Don't fall in love with some big fancy ranch.
Yeah, don't do that.
And the bigger the place, the more upkeep.
But you paying cash for a house in Boise, Idaho, or in Winnemucca, Nevada, that would be fine.
Winnemucca. I'm sure you can get a place pretty cheap in Winnemucca. I've driven through Winnemucca.
I have too. I actually camped outside of Winnemucca. Yeah, that would be fine to pay cash for it, and then set up an arrangement where your kids pay you rent if you're living in a compound.
Yeah, yeah, and then if this might be too far ahead jumping, but at that point, with what's left, rather than keeping it in cash, would that be a good time to roll it into like a Roth IRA or something?
Well, you wouldn't be allowed to roll it into a Roth IRA, but here's what I will tell you. When you get there, call us. And
don't invest it until get these other things settled first.
Yes, get them all settled first, then call us.
And I like the concept, particularly if you've got some sort of disability. I like the concept if you had a place that had a small mother-in-law unit where you had your own privacy and space, and you were able to, these dollars were able to pay for the entire property. Because if you didn't have any other expenses, presumably that your Social Security could take care of your other living expenses. And if you had some cash left over, all the better. So I think the plans. Our main concern is that you invest in something that you don't understand, that somebody sells you, that you can't get out of. So
yes, and so when you do these things, you move out of state, call the show, and we'll answer the question then.
Yeah, appreciate the call, Joan. And Pat, I always find it interesting when people inherit money. It doesn't always make life better. It depends the kind of choices people make with the inheritance.
Have you seen it? You've seen it with siblings, right? Clients, 3 children, right?
They all have different
Yeah, all clients of ours.
Yes.
Inherited money, left it all in the
All
firm.
react differently.
And then they all react differently. Some it's gone in 2 years, and some have been with us for 25 years. It's interesting. Some of them have used it to actually help finance their retirement comfortably, and some helped finance a really big weekend. Big weekend.
A big weekend.
You laugh.
I don't know what that means, but I mean, I guess I've seen that on television, on movies and stuff, what I guess a big weekend would look like.
Yeah, Weekend at Bernie's, that sort of thing.
I don't think I ever saw that. But anyway, let's go back to calls. 833-99-WORTH will get you on Allworth's Money Matters. 833-99-WORTH. We're talking with Mindy. Mindy, you're with Allworth's Money Matters.
Hi there.
Hi, Mindy.
What can we do for you?
So I have some rental properties here in Sacramento.
Are you on a speakerphone?
Or you have your hand over the microphone?
I just put on speakerphone because I couldn't hear very well. Is that better?
Yes,
thank
much
you.
better. Thank you, Mindy.
Okay. So I have some properties here in Sacramento as well as one in Indiana. And our family's in Indiana. So we're kind of contemplating utilizing the current seller's market and cashing out. But we're kind of trying to weigh the pros and cons of each. So if we sell now, we might miss out on potential rental income, increased rental income because, all of the rent control is coming about. And if we look at New York City and San Francisco, obviously those are metropolitan, so they have some bump, but the rent increases after that comes about. And then also, Sacramento's kind of on the way up, so would we lose out on future increased sale price on our houses? But then on the opposite side, if we keep them, we are going to miss out on the current seller's market that's happening right now. And later on, we don't have the option to avoid capital gains unless we move back here.
How many homes do you have in California?
So we have 3. We have one that's a duplex, one that we just moved out of 2 years ago, so we could sell that as capital gains, and we're renting it out right now. And then one that we're living in right now that we could sell in 2 years, and then move back into the duplex. And so stay here, for 3 years to get our capital gains all the way out of the way.
So, let's talk about the one that you were living in and was a rental property that you were there. That one would be the first one that you would actually look at.
Yes.
Yeah, because if you wait another year, you're going to miss the window on this, right?
And even if you you sold that and bought the house next door,
it would make sense.
It would make sense.
Even the transaction cost because
you lock in that basis. What was your basis on that house? What did you pay for it?
We paid $120.
What's it worth today?
$445.
Okay, so that's an easy. That's a no-brainer.
I'd put that on the market now.
Right now, I wouldn't even wait.
Because
I wouldn't even actually wait till the end of this call. I'd go online and list it.
We do have tenants.
Doesn't matter.
So should we sell with tenants or try to ask them to leave?
Makes no difference.
Okay.
Not at all. But
cool.
It does make you're going to limit the number of buyers potentially. So it makes
you could just write the tenants a check and they leave.
I don't think you need to do that.
How much time is left on the lease?
It's a hot market. You'll find someone will.
They're month to month, and they have not been affected by the COVID, or they haven't told us they've been affected by it, but they might claim it if we were to try to get them to
that's
leave.
an easy one. So that one, even if you were to sell that and buy the house next door to reset your basis. So whether you want to go to Indiana or not go to Indiana, and are you going to move to Indiana at some point in time?
We'd probably move back that way. We do have concerns about where California is going.
What do you mean? I'm joking.
And
That's the last caller had same issues.
I was like, is that this kind of radio station?
No, I know. Sorry.
So that's a no-brainer. Whether you buy in Indiana or not is completely different. Indiana shouldn't be the driver of it.
No, it's not.
Okay. All right. And then
how old are you, Mindy?
33.
Wow. How old's your husband?
36.
Wow. How many kids do you have?
We just have 2 young ones now.
Oh, all right.
You guys are great savers.
Yes, we are. We are very frugal. We pretended it was Monopoly money and saved it, and every time We fixed up a house that we like to live in. We rented it out.
Wow.
Bought another house to fix up to rent in, and now we're on our third one in California.
And what is your approximate family income?
My husband's a teacher, so it's like
Okay.
62.
Got it.
Well, this is a brilliant strategy, and I've seen others do this before as well, where you're in the house, and of course, real estate markets don't always go straight up, right?
Right.
And you're at the age when I started thinking about it. If you look back to the financial crisis, you were quite young, and you did not personally experience a lot of pain.
Right.
Because
we didn't lose anything, but it was harder for us to get into the job market.
Yes.
Yeah, and you didn't know what do you have mortgages on all these properties?
Yes.
And what's the mortgage on your home?
Our current mortgage on our primary residence is $227,000.
What's the interest rate?
3%.
I'm totally agree with Pat on you want to sell the house that you moved out of, if nothing else, to lock in that free pass on the capital gain because it's substantial.
Right.
And then what you do with those dollars is, you said you owed $120 on that. What do you owe on the duplex?
208.
What's the value of the duplex?
$800,000.
And what'd you pay
Or
for
more.
it?
We paid $240.
So here's one thing I want you to, and we don't have a ton of time left in the program. The period that you are looking in for real estate home price increases has been a bit of an anomaly because you were able to buy in right after the financial crisis when times were low. And it's an odd time right now where home prices look relatively attractive compared to other investments. So people are bidding up homes because they can understand those more than...
Scott, they need a financial advisor.
Well, there's no question. There's too many moving parts.
Yeah. You need a financial advisor.
There's a good financial planner to help you kind of soak, and now you mentioned you've got kids, what's going to happen? Do you want to have college savings? I totally agree with Pat. And the couple concerns you said is you're talking about prices going up. We have no idea what's going to happen tomorrow.
Right.
Right? And prices today are a reflection of the broad society of their already anticipated beliefs of the future. That's what's pricing it today. So anyway, I certainly like the way you're looking at things, and I totally agree with you.
You need to sit down with a qualified financial advisor, pay them for their time, and have them
lay out a great financial plan.
Yeah.
That will help drive all these decisions. Unfortunately, we're up against the clock. It's been great being with you this weekend. Have a great weekend. This has been Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.